Hello, everybody. Welcome back, folks. Happy Sunday. Audio check here on my end. Welcome back, folks. Happy Sunday. All right, guys. We're good to go. Hope you guys are doing well. Happy Sunday. Paul, hello to you, sir. Hope you're having a great weekend. Amy, hello, hello. How are y'all doing today, everybody? Hey, Jeff. Happy Sunday to you, sir. Ready to crush it this week. Alrighty, guys, let's get into it here today. So just a few housekeeping things before we get into the business here. A new YouTube video on the One Setup for Life series will be out likely on Monday. If it's not on Monday, then definitely on Tuesday. So just a heads up there, part 4 of that One Setup for Life series. And this I'll be covering entries. So as you know, up to this point, I taught the general model in video 1. After video 1, I showed you guys how to use the 930 opening price and how I use that to frame setups during the equities open from 9:30 to 10:30. And then in the third video, we covered institutional order flow, how to trust that the market's going to deliver to whatever target you may be looking for. And I feel like that's such a critical component to be learned before entries. And even for those I'm mentoring and coaching, I teach the same way, because entries don't matter if you don't know why you're going to hold the trade or how to even hold the trade, right? So when you give someone entries and they don't understand anything else about price action, it's like giving a low kid a loaded gun. What are they going to do? Blow their head off with it, right? So the way to incorporate entries, know why you're going to enter there, how you can trust and hold the trade, in my opinion, institutional order flow is the key to being able to do that. So I covered institutional order flow, and I'll give you guys some different entry techniques, the 3 primary ones that I use for the One Setup for Life, and that will be out on Monday, I believe. So with that being said, that's the business on the One Setup for Life series. And as always, once I get done with this series, it'll probably be anywhere from 6 to 8 videos. I'm going to teach some other things as well. And then from there, I'll move on to the next series, and I will take your guys' feedback when I'm creating that and doing the lessons plans for that. So any feedback you guys have, any topics you guys would like me to cover, I would love to take in that feedback and see what you guys want to hear. Paul, amazing weekend. Whole lot of studies. There you go, man. There you go. Head down in the grind is exactly how you want it, especially now, man. Good stuff. Omar, hello, sir. Pillow, hello, man. Thanks for the stream. Yeah, glad to be here, Chris. Thomas, hello, hello. Eslam. Simon, looking forward to gold analysis. I will touch on gold for you, my man. Joe, happy Sunday to you, sir. Alrighty, guys. Hope you had a good holiday. I know it was I believe it was Diwali for you, Joe. So hopefully you guys enjoyed that. All right, guys. So let's go and get into it. What we're looking at here this week, and as always, I will do some Q&A. I'll probably keep the Q&A light today. I do have some other things to attend to this Sunday ahead of the new week as usual. And I'll just take a few questions here at the end. I'll do gold, the usual suspects, and then any questions you guys have for me. Before I even get into this, actually on my trading, sharing some of that insight. Not an easy month of trading for NASDAQ, primary NASDAQ S&P futures. It's been a lot of give and take for me, win, loss, and it's just been really a break-even month for me so far. I had a decent run the first couple weeks, but this week drew down my account a little bit during the New York session, and now I'm sitting about break even on the month. So I want to share that with you guys, some of the insights that I'm learning myself in these very difficult market conditions with government shutdown, the craziness going on around the world, and it's unprecedented conditions that we're in right now. And it has been even a little more difficult for myself to really get in a groove and propel my equity curve higher. And it's really been the hardest it's been in at least 2 to 3 years, in my opinion, that I've been doing this profitably. So one of the things I've been doing is I've been supplementing my income with funded accounts and trading other times of the day. So New York's been about break even, but I have been doing very well in the Asia session or other times when I trade, looking for just simple setups and macro windows. It's easy to find these setups when you know what you're looking for. And that's one of the things that I've been doing to actually supplement income using these funded accounts. So I've been about break even on my New York session trading, but I have been doing really well trading other times of the day, just supplementing my income as a full-time day trader. And that's been something I have had to do recently. Because when New York's easy, man, it's easy to just make everything you need there. But it has not been easy. In my opinion, New York's been one of the most difficult sessions of the 24-hour cycle these past couple months. So just some of my observations, some of the things that I'm doing to combat that and still make sure we're making bank. So just figured I'd share that with you guys. Not been easy. So I know many of you guys have been reporting difficulty and not easy success in your trading, or at least easy success hasn't been coming in your trading. And that is a derivative of everything that we're seeing right now, guys. So if that's you, hold tight, make sure you're managing your risk, making sure you're still in the game so that when it does get easy, you still have an account and you can build it up and get back to profitable trading. So with that being said, guys, let's go ahead and get into it. And as always, I will take your guys' Q&A at the end. Joe, thanks it was. Yeah, glad to hear it, man. Much deserved. All right, guys, so monthly chart for dollar. We've been bullish for the month of October. Still looking for that to continue. Looking at the weekly chart here, we had an inside week last week. And again, the dollar, as long as we remain inside this general range that we're in here, dollar's trash. Really, Forex has been sloppy simply because the dollar just has not been moving. And if you look at from where we're at here to, yeah, even 4 to 5 months back, I mean, just overlapping price action, no inefficiencies, no displacements, not in a hurry to leave this range at all. And generally, that's going to be a high resistance liquidity run environment. So for you guys that are trading currency, surgical strikes, get in, get paid, because you're not likely to see sustained price runs with this type of price delivery here. So we were looking for a bullish week last week. We got it, but it was an inside week, so nothing too much, nothing too exciting there. Not too many targets delivered, but nonetheless, got that expansion higher we were looking for. Still having a hard time getting above this wick midpoint. So if we're going to remain bullish, I'd want to see us power higher through that. The last line in the sand for me for bullishness will be this down close candle here. So as long as we remain above that, I am neutral to bullish on US dollar. So given that we had an inside week here, the previous week, I am expecting a bit more volatility here for the new week. And we also do have FOMC on Wednesday, so that should be the catalyst to provide the volatility. All right, so last week, we opened up here on Monday. We talked about the draw being this gap here that I now have labeled inversion gap, because you see here we retraced into this range. What range? This low to this high. Equilibrium's about here, so they dropped it into a discount. So it's really easy for me to see that they were going to want to take it back up into a short-term premium. Let me just show you guys what that looks like in case you're having a hard time picturing it. All right, so the 0.5 level here, that's equilibrium. So they dropped it down here into a discount market. And then how do we react inside that inversion fair value gap? Bullish. So from there, I was able to see that the market would want to gravitate from discount just up to a short-term premium. More specifically, this imbalance here is a target. Once we got above it, we just kind of banged around inside that range, which is kind of, as I just mentioned on the weekly chart, not a whole lot in terms of excitement for the US dollar because of how we're delivering top down. It's just not that clean. We can still have precision elements. We can still see where it's going to draw to on a short-term basis. Just understand that the higher time frame is really going to prevent the market from seeing these sustained price runs until we see a meaningful move outside of this range that we're in here. Once we see a meaningful move outside of that, then we can start to trust cleaner price action. But as of right now, that's simply not the case. So here's what I'm watching going forward. We left discount, expanded to premium. I want to see how we trade inside this inversion gap. On Friday, we opened, we dropped down. We hit the BISI here, which is the buy side imbalance, sell side deficiency, this fair value gap. Hit it, found support. As long as we remain above the midline here, or mid gap, consequent encroachment of this fair value gap, that leads me towards a bullish bias. So we already dropped down to discount, so there's no need for this low to be taken out. So this low here, I do not want to see that attack. I want to see us stay above this inversion gap and rally if we're going to be bullish. And then the targets on the upside would be the buy stops here, the body of the candle here, the highest close, that'd be the rejection block, and then we have the buy side back here. So as long as we remain bullish, that's my draw higher, but we need to stay supported inside this inversion fair value gap here. This low here is not a factor to be taken out, and if we do take out that low, that would change my bias just about altogether. Alrighty, so looking at the 4-hour chart here, moving right along. So they left these equal highs here, dropped it down to a discount of this range. From here, we rallied, breakaway gap, seeing bullishness. We dropped down on Friday, cleared out these equal lows here. So I'd like to see it rally straight from Sunday into Monday and clear out these highs here. And then if we start to accelerate above these highs on the 4-hour chart, then that takes us to this high back here. Call it the 100.2 level for dollar. Alrighty, moving right along into bonds. All right, so bonds, we took out the buy side here, that swing high on the weekly chart, and now we're starting to see the market retreat a little bit off that. So we're starting to see a rejection off those highs here. We have an S&T divergence. You guys are probably thinking, where's the S&P at? They all took out the high. Great question. So I'm looking at SMT with the bodies. So you see here, the market traded higher. It took out this high with the bodies. But what do we see here? Market rallies. The bodies do not get above that high. And then you can see here in the 5-year treasury, the bodies do not get above this body here. So if you just look at the market on a basis with the bodies here, you see the bodies did not make a higher high. And let me show you here. Just the wicks. You can see the S&P divergence here. So you can see the bodies failing to make a higher high in the 5-year treasury and doing so in the 10-year and the 30-year. So that is a form of an S&P divergence. Let me put the wicks back on here. So if that S&P holds and we start to see a rotation lower on bonds, that will allow the dollar to rally. So that's what I'm watching right now. So we rallied higher, we took out the high, but we didn't displace above the high, right? So we didn't expand above it aggressively, indicating it's still trying to reach higher. We trade above the high and reject it, signaling potential weakness going forward. So as long as this S&P holds, I'm looking for lower prices on bonds, which will further support higher US dollar. All right, and then working down into the 4-hour chart here. So we can see they swept the highs, broke down, retracement. So as of right now, it looks like we got some pretty solid market structure for the market to rotate lower, intermediate term high here. So we would not want to see this high taken out if we're going to remain bearish. And looking at the daily chart, what's of interest to me if we start to sell off is we have all this trend line liquidity here. So you can see like from here to here, you can draw an obvious trend line there. Many times the market will want to run through that. So if we do remain bearish, this trend line liquidity here is of interest to me, and that would again further support higher US dollar. All right, moving right along over to NASDAQ here. We will start from the monthly chart. So we remain bullish on indices. So looking at the NASDAQ here, bullish monthly candle of October, we dropped, made the low inside this wick here and rallied. Couldn't even get down to 50% of that wick, indicating the market is bullish. So last week, we zoomed out before dropping into the lower time frames. And what are we seeing on the weekly chart? Still continuous bullish order flow. Every down close candle, every inefficiency supporting price higher. So again, that's not something we're trying to stand in front of and try to call it top. So we took out the all-time high here on Friday and we closed above it. So what I'm interested to see is how we trade above that high going forward. If the market is to remain bullish, we will likely see continued displacement and energy above that high. If we do, then that's just going to tell you to keep trusting your buy models, looking for higher prices. If we reject and break down below that high, then that could potentially give you insight of a reversal, but not trying to call a reversal, call it top in this market just yet. Because as we always say, when the top's in, it's going to be in. And we'll be able to see that when we get there, but trying to predict it ahead of time, in my opinion, is a loser's game. All right, so bullish order flow on the monthly, bullish order flow on the weekly. Now let's drop down to the daily. So we finally have left this range here from this Friday on October 10th, and we saw this drop into these lows here. We were banging around inside that range for a while. We finally left it to the upside and laid a body over this high here. So what I'll be interested to see going forward is, do we see that continued displacement higher, which is what I'm favoring, again, just avoiding calling a top in this market. And what I will use for fib projections will be this retracement right here. So you can see we hit that 0.5 level perfectly, making Friday's high. If we see some speed above that here, we'll just call this 2,600 big figure number. So I like that -1, and then above that we have -1.5 on the upside for indices. Everything is bullish as long as you remain above these two down close candles here. So these two down close candles on the daily chart, the market has no business getting below that if we're going to remain bullish. If we lose those two down close candles, then that would completely shift my perspective in indices, because we already dropped down, filled the imbalance, hit this bullish order block here in the form of this last down close candle, and we rallied. So in my mind, there's no need for the market to trade back down through the bullish order block here. So I want to see expansion through that. And the same is going to go for S&P. Here we see ES, same deal. And the Dow, same thing as well. Breaking the high of the range and showing strength, showing bullishness to the upside. So higher prices on indices is likely in order until we see a shift in the order flow on that daily time frame. So that's the business there. We're seeing, as of right now, bullish dollar, bullish indices, and I'm interested to see how we trade here with the bonds going forward. Because if we can start to see the bonds loosen up, that will just make everything a lot easier. Meaning, look at the bonds over the past 2 years. The bonds have been consolidated. So when the debt instruments aren't moving, it makes it really difficult for other assets to see sustained movement as well. So the reason it's been more difficult is because, again, we've been seeing this range on bonds. So if we can leave this range in the bond market, that will just make everything a lot easier because other asset classes will be able to enter trending environments. Alrighty, guys, so that's it for me here. I'll take a look at gold, take a look at crude oil, and let me see your guys' questions here. Make sure you guys get them in here before I get going, just so I can make sure I hit your guys' questions. All right, so we'll start with gold, and then we'll see what else you guys got for me. All right, so zooming out, again, as always, starting from the monthly chart, we're at all-time highs, so keep looking for higher prices on gold. Now, that does not mean we can't see some wild, savage retracement, right? So they can give a huge retracement to the downside and still continue higher. I'm still extremely bullish on metals longer term. Now, that does not mean I'm saying every single day is going to open at 9:30, rally higher, and close higher, and you just buy every day and it's easy money. I'm not saying that either. I am bullish, so we're looking for higher prices on metals as a longer term macro outlook. That does not mean that every single session is open and close higher, though. So you also have to understand how to trade. You also have to understand how to weigh out other things. It's not just every day, just randomly buy the market. You have to understand order flow, market structure, time of day. Things are going to lend well towards high probability setups. And if you don't have that, it doesn't matter if the market's bullish, the setups can still fail you. So keep in mind that I'm not saying for a trading perspective, every day is going to be bullish. It's a long-term macro perspective, investor in gold and silver, it's going much, much higher. Not financial advice. So looking for bullishness on gold, just looking at the monthly chart. Looking at the weekly here, we have seen several consecutive weeks of bullishness, so it's reasonable for this market to retrace on this time frame. So looking at this here, we have a weekly imbalance here and here, so it's reasonable for the market to trade down into that. How we trade inside these fair value gaps here will be key going forward. Working down into the daily chart here. So we dropped down on Tuesday, created a imbalance here, traded up into it, and we're starting to sell off and reject it. If we do sell off from this daily fair value gap created on the 21st of October, then your attention should drop down to those weekly gaps. I don't have them labeled on my chart. I don't trade gold, but you want to have those weekly fair value gaps here and here labeled. If we stay below this daily gap here on Tuesday, then that will take us into those levels. If we trade to and through this fair value gap here, then we're likely going to resume all-time high trajectory. All right, and then for silver. Yeah, so silver is going to be the same deal. Extremely bullish. We've reached old historical level of $50 an ounce. We poked through that, and now it's reasonable to see a bit of a retracement, right? We've just reached external range liquidity here, so it's reasonable for it to pull back into the range. Looking at the weekly chart, same deal for silver as we discussed on gold. So if we do start to retrace, where's it going to retrace to? Fair value gaps. That's the go-to tool when you're in a retracement. All right, and then looking at the daily chart, same thing as we discussed for gold. So you have that fair value gap on Tuesday, the 21st of October. We traded up into that, and so far we did what? Broke down and rejected it. So if we stay below that gap and start to see bearish order flow and the market roll over, these equal lows here are of initial interest, and then we have that weekly gap that you should have labeled on your chart if you're going to be focused on silver and gold. But again, it's all predicated on how we trade from this level and the institutional order flow that you see in your lower time frames. Silver and Bitcoin. Yeah, let's take a look at Bitcoin. So same deal for Bitcoin. Bitcoin's at all-time highs as well. We took out these lows here, and I wanted to see how we traded below these lows. We did not see a displacement through the lows. So we took out the lows, rejected, and are trading back higher now. So this could have been just a stop run here to continue higher, and that would have satisfied that 2022 model that we were looking for here, which is buy side run, breakdown, shift in market structure, retracement of the gap, breakdown, attack the lows. So we saw that deliver, but now that we took out those lows, I was monitoring. I wanted to see how we traded below these lows here, right? Do we start to accelerate, really break down, reach for lower lows? Or does the market trade below these lows, reject, and start to rally higher? As of right now, we're starting to see that rejection of the upside. So as of right now, we're seeing bullishness on Bitcoin. So we have this high here from the 21st of October, this high here from the 13th on the daily chart. And if we start to rally, these two highs are of interest, and then the rest of this imbalance. If we then get above here on Bitcoin on a closing basis on the daily chart, and then we use it as support and rally, then we're likely going to stay seeing all-time highs as it relates to BTC. So zooming out on the weekly chart and the monthly, everything does still look bullish as of right now. So tough position with where we're at right now in Bitcoin, because obviously we're really expensive, right, off the lows here. So Yes, we're likely bullish, but does it make sense to buy up here? I don't know. It just depends on your risk profile, your strategy, your style of trading, and your strategy essentially. So as of right now, I'm neutral to bullish on Bitcoin. So we'll just leave it at that. Neutral to bullish. These are the targets I'm looking for, and then how we behave inside this key level will give me a longer term perspective on Bitcoin. Simon, thanks. Yes, sir. All right, guys, got anything else for me here? Hey, Thomas. Hello, hello. All right, I'll look at crude oil, and then if there's no more questions, we will get going here. All right, guys, so I'm of interest in crude oil right now. I know crude oil has been a sleeper for a long time inside this range here. It's been a ranging asset as of recent. So now that we've dropped down, we've cleared out the rejection block here, the bodies, I'm interested to see how the market trades from these lows, because we have all of this stacked trend line liquidity here. So when crude, sorry, still stuck on last asset, think about gold. When crude oil moves higher, it's going to move. And it's likely going to be some geopolitical catalyst that causes the move in crude oil. And so here's what we're watching right now. We dropped down, we swept the bodies here. We did not take out the lows, but we don't need to. Here's what I'm watching on the daily chart. So we have this inversion fair value gap here. I want to see how we trade there. If we can stay in the upper half of this fair value gap here and not explore the lower half, and if we leave this fair value gap here open and treat it as a breakaway gap, that will be extremely bullish for crude oil. And I will be looking for higher prices back up into the $66 a barrel, $70 a barrel, and then all the way back up into the 80s if we see that specific signature there. But as of right now, not trying to call a bottom in this market. If they do want to do one more pass lower and sweep out the lows, that's fine. It'll just trade through this level and give me that feedback. However, if we behave as I just mentioned, that will be extremely bullish for crude oil. Chris, so for inversion fair value gaps, you only need them filled, no body closure before classifying them as an inversion fair value gap, right? Well, that just really depends on how much visibility you have, right? Meaning, let me go to an example here with NASDAQ. Let me go to another trading day. Great. All right, so let's look at this example here. All right, so let's say you are bullish on NASDAQ, right? We got this market here. We're looking for higher prices. We're going to expect it to draw into these highs here, right? Like that's the draw liquidity. Well, if that's the draw liquidity, the market's going to trade up into those highs. We already did what? We opened at 930, surged higher, created a fair value gap. We hit the fair value gap and did what? Rallied, stayed in the upper half. That's bullish. So now we have everything behind us in terms of underpinnings for a bullish market. Now we'll drop down to the 1 minute chart and answer your question. So for inversion fair value gaps, do you need them filled all the way? Not at all. So when you get really good at reading price action, you'll be able to see that this fair value gap will be an inversion before we even get there. Why? Because if the market's going to draw higher and clear out this high here, then it goes without being said that this fair value gap here is not going to send us lower. So classifying inversion fair value gaps all comes down to how much visibility you have. Early on, you're probably not going to be able to see this is going to be an inversion fair value gap. So you have to do what? Just watch it, right? Wait for the market to get above it, close above it, use it as support. But this is something that my guys see me, and gals, see me do every single week when we're live. Call inversion fair value gaps before we even get there. And the understanding is if we're going to rally here and trade to these highs and beyond, then it goes without being said, this fair value gap's not going to send us lower. So if it's not going to send us lower, what's it going to do? It's going to be an inversion. It's going to invert its role, right? So the closure above an IFEG, none of that stuff is necessary. All that you have to understand is what's the draw liquidity? Where's the market reaching for? And then how's it going to use these PD arrays in a very simple way? And if it's not going to sell off from that fair value gap, then it's just going to simply do the opposite and use it as support. So closure above, closure below, that's nothing that I personally use as confirmation. That's what you want to see, right? If you have the inclination or the possibility that, okay, this gap is going to be used as an inversion, then you want to see that, right? You want to see the market close above it, but it just depends on how much visibility you have. If you're new or you don't have the ability to read price at a high level, then that's fine. You can just wait for those signatures, wait for it to close above, and that's going to give you what you need. But as you have more visibility, if you understand your draw and liquidity, then all the puzzle pieces unlock, and you can see them ahead of time. So yeah, you don't need them filled, and I'm not sure what you mean about the closure, but no, yeah, none of those things are required. It's just drawing liquidity. Where's the market going? And then once you understand where it's going, then you can put the puzzle pieces together. Good question. Paul, how do you frame? Yeah, good question. So commodities are priced in what? Priced in dollars, right? So if commodities, very similar to gold, right? Gold and crude oil is priced in what? In US dollar. So if the US dollar is getting stronger or bullish, then that's going to be what? Bearish for gold and crude oil, right? Because they're priced in dollars. So if the dollar's stronger, it's going to take less dollars to buy the same amount of crude oil and gold. If the dollar's weaker, right, and the dollar's being devalued on a relative basis to other currencies, then you will see an easier, you'll see that gold and crude oil have an easier time rallying, because if the dollar's weakening and they're priced in dollars, it's going to take more of those weaker dollars to buy the same amount of gold or crude oil. So it's just simply understanding how certain assets are priced in a currency, and how that currency moves is going to affect the valuation of those assets. So for commodities, it's actually really simple, just the opposite of dollar. So very similar to what we look for in gold and indices, right? If you have strength in dollar, that's going to be bearish or risk off for other assets, and it's going to be the same for your commodities, because again, they're actually priced in dollars. A good question. Can you explain when to expect if price is just going to sweep the low or just the body? Sometimes you don't know. You just have to see how they trade at those levels. I don't always know if they're going to come all the way down for the lows or sweep the bodies. But S&P is going to be helpful with that. Like if you have S&P between ES, NASDAQ, and that just depends on also how bullish you are as well, right? So sometimes it will just sweep the bodies and it doesn't need to take out those lows. And if you're really bullish, then you can still buy with those equal lows below, trusting that the sweep on the bodies was enough. Safari, GU, and EU. Okay, yeah, I'll get the EU and GU in a moment. Paul, so I'm especially referring to... Hey, Samurai. I'm doing good, sir. I'm doing good. Thank you for asking. So I'm especially referring to the real world worth behind oil. So for the macro perspective, big picture, you look at it when it is rising, dollar is weakening. Yeah, I see what you're saying, Paul. And you're kind of stepping out of my realm now, right? So now you're getting into fundamentals. And one of the things that I've learned is fundamentals is just a whole beast in and of itself. Can you derive clarity and macro perspective from fundamentals? Maybe, sure. But it's way above my pay grade. And figuring out all those details behind it, in my opinion, is just way too complicated. It's a waste of time, in my opinion, for me. Maybe it's not for everybody else, right? So if you're making money with what you're doing, fucking awesome. For me, I just think it's a huge waste of time. Everything that I need to see in the price action will tell me what I need to know. So I don't really get stuck in the weeds, and it helps everything stay easy for me, right? Because as traders, we don't want to complicate it. We need simple. This is what we're looking for. This is exactly how the market's going to behave if it's going to be bullish. This is exactly how the market's going to behave if it's bearish. And in my opinion, all the economic reports and fundamentals and trying to weigh all that out, in my opinion, it's a hard game to play. I'll just put it that way. Thanks, man. Yeah, I got you. But, if someone that is able to see success with it, or you want fundamentals as a confluence behind what you're already looking for, is it bad in that instance? Not really. I wouldn't discourage you from looking at it, but it's just really easy to get in the weeds and overcomplicate this. And the cool thing is we cut straight through all the bullshit, right? So we don't even need to worry about all these other geopolitical, this, that, because it's just going to cause a lot more confusion, in my opinion. So it's good if it's helpful for you, but in my opinion, it's more of a distraction than anything. But yeah, that's a whole nother world in and of itself, right? How, the economic perspective, what that's going to do for crude oil and whatnot. So One of the big ones though is like war, right? And like if war happens, then crude oil just goes to the moon. So like that is like a more simple fundamental perspective to apply, because to power all these war machines around the world, you need an ungodly amount of crude oil. That's why anytime bombs goes off or someone threatens this person or whatever the hell's going on, you see crude oil just spikes like crazy, because the war machines require crude oil. So on a basic level of like fundamentals, if you ever have like war, saber rattling threats, shit like that, crude oil loves that to explode higher. So from a simple fundamental standpoint, that's something I do use, but you know, you can't really predict, when they're going to start lobbing bombs here, lobbing bombs here. So at the end of the day, it's not really that helpful. But if you have a confluence like bullish order flow, and then you see headlines of war and shit like that breaking out, then it's just going to be even stronger for crude oil. Yeah, 100%. I did a deep dive into this kind of stuff this weekend because personally I find it quite helpful and trusting long-term correlation between Bitcoin, dollar, debt. Yeah, absolutely. No, for sure. And if it's helpful in giving you clarity from a macro perspective, that's awesome. And essentially, it's the same thing that we're doing here as well, right? We're looking at the dollar, we're looking at the bonds, which tells us where the yields are going, and then we're using that to derive a conclusion as to whether or not we're risk on, risk off, and then we can apply that to whatever assets we may be trading, whether it's indices, stocks, crude oil, gold, whatever the case may be. So at the end of the day, I think it comes around the same conclusion anyway. So if it's helpful for you, then that's awesome, man. Yeah, absolutely. Yeah, definitely. Understanding the why, in my opinion, is very helpful. So if that's giving you clarity, sweet. Alrighty. Can you do upcoming weekly analysis on NASDAQ, please? Yes, sir. I've already done that. That will be in the recording for your convenience. Justice, late to the party. What's up, my man? Hope you're doing great. Chris, are there any circumstances? Chris, are there any circumstances in which you position in Asia anticipating the continuation in the daily candle, or do you only look for smaller moves in Asia? Great question, Chris. So for me, Asia, I just scalp it. I am not trying to hold trades in Asia. If there's no high impact news in the following New York session, said many times, you will see Asia make the higher low of the day, but for me, it's not necessary. If I can go into Asia to get my 20, 25, maybe 30 points, depending on how much volatility there is, that pays me very well across multiple funded accounts. So at the end of the day, I'm just here to get paid. Holding for the daily range in Asia is not something I'm personally interested in. If that's something you want to do, then like I said, that's the criteria. If there's no major news later on, then Asia can make the higher low of the day in those circumstances, but I never try to position for the daily range in Asia. In my opinion, it's just a hard game to play. If you're trying to position for the daily range, London or New York, and understanding how London affects New York will give you all the insight you need in terms of positioning for the higher low of the day. But trying to do that in Asia, in my opinion, is just going to be a really difficult game to play, because most times Asia is what? Consolidation. So if it's consolidation, there's specific scalps and trades that form every single macro in Asia, but you do have to know how to trade in a consolidation profile and what consolidation means, which means it's going to refer to fair value, and you need to understand what fair value measurements the algorithm is going to refer to during that time. And now thinking about me saying this, it sounds really complicated, but it's really simple. It's just understanding that it's going to range, it's going to attack the extremes and the highs and the lows, and it's going to pull back into the range and reach for that new day or new week opening gap, depending on the day it is. And that is in a nutshell, is the Asia model that I trade. And of course, aligning that with my macro windows. So I have a question, Dylan. When we look at SMT, so the one that doesn't make the lower low. So if you're bullish and you have a SMT divergence that would be bullish, then you're saying that one asset is making a lower low, the other correlated asset is not making a lower low. The one that doesn't make a lower low is under heavy accumulation. If it's under heavy accumulation, it will generally be the relative strength leader. So just whichever one fails to make the lower low when you're bullish, or the one that fails to make the higher high when you're bearish, that's going to be your relative strength leader or your relative weakness leader, depending on what you're looking at. And then you can use that for relative strength analysis to know which asset is weaker or stronger. All right, I said I'd do EU and GU. So like I said, like I said with the US dollar, the dollar is just in this, not soybeans, dollar here. The dollar is just in this really nasty range here, right? So it's essentially going to be the same thing for euro, pound. Pound's a bit weaker than the US dollar, or than euro dollar rather. So if you're going to short, pound in my opinion would be the better asset. And you can see here the euro pound is bullish, so that means that the euro is weaker. No, yeah, no. So that means the euro is weaker and the pound, no, it's the opposite. I'm mixing it up in my mind. Sorry. This means the euro is stronger and the pound is weaker. So you can see here that pound selling off more relative to euro. But again, looking at what we talked about in dollar, you can see the same thing here, guys. I mean, look at this price action on the weekly chart. It's just all overlapping price action. There's no fair value gaps. There's no displacements. So this is indicating it's a high resistance liquidity run, which is just going to be more problematic price action until the market starts to clean up. And what do I mean by clean up? Well, look at the difference in this, I don't know, 6-month stretch of trading here. And look at the difference in this 6-month stretch of trading here. Which one do you rather trade? The one where it's loose, where there's imbalances, it's hitting the fair value gap, it's quickly leaving them, it's moving, or where it's just all this overlapping kind of strangled price action, right? This is very, very difficult here. This is very easy to work with. So that's why I don't have a lot of visibility as it relates to, I think one of the cats right here. I don't have a lot of visibility as it relates to euro and pound because we're just in this nasty consolidation range like we've been seeing with dollar. So don't have a lot of visibility in these markets. Once we loosen up kind of like this type of price action here, then I will share more in the currency market. And I'll probably be trading it more myself as well. Thank you. I understand. Awesome. All right, guys. Thanks for your questions. Appreciate you guys joining us here today. Do hit the like button on your way out if this one was insightful. And I will see you guys on the next one. Have an amazing rest of your Sunday. Stay tuned for our next YouTube video. It will be out. And as always, give me your guys' suggestions on what you guys would like to see going forward. And I will put that into my lesson plans and share that with you guys. So with that being said, have an amazing weekend. Stay safe this week, guys. I'll see you on the next one. Bye, everybody. Yep. See you, Paul. Take care, Joe. Bye, brother.